Holy flippity flip flop flap and smokes, everyone. Let me know in the chat below if you can now see that everything's working fine, that the audio is fine. According to my tech here, we should be live now. Sorry for the delay. We had some technical difficulties, but I thought I'd do a live stream because I hadn't done one in a while, and there's a lot of news to cover right now. So again, let me know in the live chat below if everything sounds good. We're ready to go. Okay, according to the chat, everything sounds good. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. So I'm just waiting for some people to join here. Probably a few dropped off because of that delay. But yes, the reason why I'm doing a live stream today, emergency meeting, why things are getting worse, what we're going to cover today is, what we're going to cover is we've got some new comments from the Federal Reserve, and there's some big comments, and that's the reason why we saw huge volatility in the markets today. We've also got some new information with what's going on with the cost of living crisis. We've got some new information with what's happening with the housing market, and also some big things, why things are getting worse, and something big I think is coming. What's happening with the relationship between US and China? The relationship between the US and China is deteriorating rapidly. We've got some new things from China with them calling out Elon Musk after Elon Musk sharing what was going on with the big cough originations, wink wink. So yes, a lot to cover today. And it's awesome to engage with you guys live here in the live chat. Haven't done a live in a while, and it's good to see the community here, you guys chatting together. And it's good to do this once every now and then. So okay, let's go right now into our first story here. So Minneapolis Fed wage growth is too high for our 2% inflation target. Now, forgive me if I misspeak here or do a gaffle. Hopefully, I'll do a better job than Joe Biden. But we need to talk about what happened with the latest Fed comments today from the Minneapolis Fed. Okay, so here, according to what he said, a couple years ago, I said, and my colleagues said, some of these factors look like they are temporary or transitory. Supply chains are going to get sorted out. Well, yeah, that's kind of sorted out, but we're still having some issues there. So maybe we do not need to overreact. Well, that didn't turn out too bad for them. Remember the transitory inflation, everyone? It turns out inflation's a lot longer than they thought, and they've been slow to react. Well, it took a lot longer than we expected. Yes, it did. And now you are seeing wages climbing, and wages are climbing, trying to catch up to that inflation rather than leading the inflation. But now wage growth is at a level that is actually too high to be consistent with our 2% inflation target. So this is something big, everyone. A lot of people thought first inflation was transitory. Then they thought it peaked. Then we had what Jerome Powell saying, disinflation. Well, now we got new data that shows inflation is skyrocketing again. And we've got even more newer data to say that wages are now climbing, and that's going to keep inflation elevated. Because if prices go up and then people's wages go up to meet those prices, then they can somewhat afford it. Now, we all know wages aren't keeping up with real inflation, and real inflation is much higher. But if inflations do keep going up, then that can create what the Federal Reserve fears is a wage price spiral. So let's go into some other things that they're very worried about in the economy and why things just may not change overnight like they're hoping about. So traditional tools are not working. This is a very complicated economic environment that we're in terms of our ability to analyze it using the traditional analytical tools that we have. So we have got a very complicated economy since COVID. We've had huge supply chain issues. We've had worker shortages. We've had 0% interest rates. Now we've got interest rates skyrocketing. We've got labor shortages. And also what we're going to go over in a moment is huge demographic shifts. We had the baby boomers. They were a huge part of the workforce, but now a lot of them are retiring. And millennials aren't having many kids there now. So there's going to be a huge supply of workers coming over the next couple of decades. So getting inflation down, listen to this, more important than avoiding a recession. So you have the Federal Reserve saying now that getting inflation down is more important than avoiding a recession. So they're saying a recession is going to come, and even if a recession comes, but inflation is still high, they're still going to keep hiking. Because what you had is a lot of people saying, or a lot of the markets are hoping for, is the recession will come, because the stock market is not the economy. The stock market actually wants a recession to come. They want unemployment rate to go up. They don't want people to get a pay rise. They want companies to announce more layoffs because then that helps pump their stocks. All they care about is 0% interest rates, cheap money, and money printing to keep their stocks inflated. So what I think is going to be a rude shock for them is when we do get that bad news that recession's coming, we're going to be facing stagflation, where inflation is still very, very high and the Federal Reserve has to keep on lifting interest rates, and they're not going to get those rate cuts that they've been pricing into the markets. And that's why we're still going to see more pain for the stock market coming ahead. Now, also, they're finally admitting it. Monetary policy cannot address structural issues. So, for example, they can't print oil. They can't print food. They can't buy better supply chains, okay? There's simple structural issues that the Federal Reserve can't do anything about. All they can do is crush demand. So monetary policy can try bringing the economy into balance in the short run, but the long run, structural issues, monetary policy cannot do anything about. So again, they can't print oil, they can't print food, okay? They can't give UBI yet unless they bring their CBDCs. So there's a lot of things the Federal Reserve has no control over, and that's why interest rates are still going to have to keep going up. Now, also, as like I was talking about, demographic labor challenges. So all advanced economies around the world are facing labor challenges because advanced economies are having fewer kids than prior generations, and those fewer workers to produce things, and there are fewer workers to buy things in the future. So this is another massive, massive thing that I don't see many market commentators talking about right now, is this massive demographic shift. The baby boomers, they're the wealthiest generation right now. They're going to be retiring. They're probably going to be selling stocks. I'll get into later how there's a huge rush of cash into bonds right now with yields over 5%. And simply, there's just not going to be enough young people to fill these job positions. And that means there's going to be this pressure on wages, of course, unless they, open the borders and just let immigration run rampant, which is actually what they want. And we'll get into in a moment. So immigration, they say, is the only answer. So Japan is trying to pay their workers to have more babies. It doesn't work. The only answer, they say, is immigration. This is a structural issue that we as a country have to get our head around. Sensible immigration policy that meets the needs of our economy. He said he's not making a political statement. I've met Republicans and Democrat leaders who all understand this. It's simply math. So he is right, simple math there. If you're not having more babies and all the baby boomers are retiring, there's not going to be enough workers, and they're going to need immigration. Now, hopefully they can have legal immigration, not illegal immigration like what we're seeing at the border right now, with it being completely overrun. Hopefully they do more targeted legal skilled migration to fill these specific industries or the specific skill gaps and fill these jobs, not just, open the floodgates and let illegal immigrants in. And then also what that does is that makes wages lower, but it makes house prices higher because there's already housing shortage. If they create immigration, then there's going to be even more demand for housing, more demand for food, more demand for gasoline. So what it does is it keep wages low, but the costs even higher. So also here, March rate hike and dot plot. So it's going to be very interesting to see what the Fed does during their March meeting to say where interest rates are going to go. So there's a lot of attention on March. Is it going to be 25 basis points or is it going to be 50? I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's more important is whether it's 25 or 50 is what we signal in what we call the dot plot. Now, that's exactly right, everyone. A lot of people are figuring out, should they do 25? Should they do 50? Or they're really worrying, okay, if they do 50, that's really bearish. And yes, that is in the short term. But really what we need to pay attention to is where are they actually going to end? They could do 1% now, and yes, it'll be bad now. But if they only lift interest rates to 5.75%, yes, they'll be bad. But what would be even worse if they just do 25 basis point hikes, but inflation gets out of control and they actually have to lift interest rates to 8%. So it's not about how fast we get there. Yes, they'll create volatility in the markets, but it's more about where we end up. So in December, when he jotted down his dot plots, he said, I jotted down that I thought we would get rates up to 5.4%. That's more than the markets are thinking now, and then told them would be there for an extended period of time. And he said he was one of the more hawkish. So this is a person on the Fed board here. He was more hawkish among his colleagues. Given the data we have gotten in the last month, which has been a very strong jobs report, higher inflation than we expected, and these are concerning data points suggesting that we are not making progress as quickly as we'd like at this point, and I've not decided what my dot is going to look like, but I lean towards continuing raising rates further, and I'll continue to push my policy path. So, guys, what this means is there's going to be much, much more rate hikes than the markets are pricing in. And all these people saying, well, don't worry, when the recession comes, the Fed's going to pivot. No, I think what we're going to be facing is stagflation, where the unemployment rate ticks up, inflation stays high, and also what we're going to have is, like I said, higher rates. The market's not prepared for this. We're going to have a recession, and also the market is not pricing in a recession. They're pricing in this soft landing or no landing. Well, I think we're going to have severe pain, but the Federal Reserve is going to have to keep hiking, and this is something nobody's prepared for. So what he continues to say here, if the Fed was not so hell-bent on producing this 2% inflation while not understanding what it really is or the nature of what they seek, perhaps more people would want to have kids. So this is a commentator saying here, well, the reason why people can't have kids is because the cost of living is so high and inflation is much higher than their 2% target. The same applies to government control over our lives. So that's another thing there, people worried about the government, people worried about, losing their freedoms, people worried about the world right now with the geopolitical tensions. Maybe they're worried about bringing kids into a world that's very uncertain right now. And so they need to fix some of these issues, the geopolitical issues, and also the cost of living crisis. Otherwise, you're going to have more and more families that cannot afford to have kids, or if they do, it's going to be very tough. Now, another story here. A year later, and the Fed still has a long way to go to fight against inflation. So that's right, everyone. It's been over a year. People thought, the Fed will do some hikes. It'll drop straight back down. But no, that's not happening. And now we have here the BIS. This is the Bank of International Settlements. This is the central bank for the central bank. And they're very, very worried right now that central banks may have declared victory too early, like Jerome Powell said, by saying we've got disinflation now, and then next month we got literally sky-high inflation. So he's saying here, central banks need to get the job done when it comes to getting inflation back under control. The Bank of International Settlements has said, urging them to avoid the mistakes of the 1970s by declaring victory too early. So that's exactly right, everyone. What people may think is, okay, inflation, prices just go straight up in a line. Where no, it's actually very volatile. You may have prices going up for a bit, then they'll dip. Then people will think, okay, we've got disinflation, we'll start lowering rates. Well, then we only get inflation surge again because, you're comparing prices with month over month. If prices surge in a month, then the next month they may stay flat. That doesn't mean we have disinflation. That just means prices aren't going up at the same rate they did the previous month. And also Michael Burry warned about this in one of his Twitter posts last month, saying, don't declare a victory on inflation yet because inflation can be very, very volatile. So he also go on to say here, central banks have been very, very clear that at this stage, the most important aspect is to get the job done, the head of BIS Monetary Policy and Economic Department said. Also, what they're going on here. So we can see here, list of countries where they've lifted interest rates. Right now, the US is number one. They've done 450 basis point hikes, or they've lifted their rate to 4.75, followed by Canada. They're now got rates at 4.5. New Zealand, 4.25, UK. And look at Australia. Australia's being a bit of a wimp there. We've only lifted rates to 3.35%. And a lot of people in Australia, thinking that's it, not going to have any more rate hikes. Well, I think a rude shock is going to come for a lot of Australians that we have to follow what all the other central banks do. Otherwise, our currency will get absolutely decimated and will absolutely see the Australian dollar crash. And if the Australian dollar crashes, well, then that makes everything we import, which we import a lot, much, much more expensive. So to wrap this segment up, which I'm about to get into another very, very important segment about what's going on with gas prices in the US, we're about to see a huge gas crisis. People simply can't afford it. But to wrap this segment up, we're going to have interest rates higher for longer. Inflation's getting much, much worse. the markets haven't priced in what if interest rates go to 6 or 7%, and they also haven't priced in that when we do enter recession, the Federal Reserve's not going to pivot. They're going to keep lifting rates if inflation stays high for longer. So, okay, let's now get into our next story here, everyone. So, you are killing us. So, Southern California gas prices, Southern California gas seeks 13% monthly bill increase. So, this is absolutely crazy, everyone. Gas prices for people's utility bills have already increased like 300%. And now they're seeking another 13% monthly increase. And this shows why real inflation is much higher than the CPI report. So let's dig a bit deeper into this report to see what's about to happen to the residents of Southern California to their gas bills. So as millions recover from the exorbitant utility bills, the state is considering Southern California Gas Company requests to raise monthly rates by 13.2% next year for 5.3 million households and businesses it serves. So this isn't just going to affect households, this is also going to affect businesses. Businesses simply can't afford these higher bills right now, as well as households. And even if they can afford it, well that's what's going to lead to. That's going to lead to higher prices for them because, like gas, like people transportation goods, and also people using power, electricity, and gas, that's a huge input cost for business, and they're just simply going to have to pass that on to customers. So what this is mean? More inflation, more cost of living crisis. Things are just getting worse, people. It's absolutely crazy. I thought, people hope that maybe this was the end of this crazy high inflation, but it just keeps getting worse. So although the increase is a routine request by SoCal Gas every 4 years, it comes at a time when many residents are paying as much as 300% more for gas. This is absolutely crazy, a 300% increase. Imagine all the pensioners, imagine all the veterans. They simply can't afford another 300% increase in their gas bill. And this is why we're going to see the homeless crisis in California. And this is going to start spreading across the country. It already is spreading, but it's just going to get much worse because people can't afford the crazy high rent increases, the crazy high utility increases. And this is probably why we saw used car prices skyrocket last year. There's a lot of other factors, but we're going to start to see a lot more people live in their cars. So skyrocketing costs for natural gas sent bills soaring in February because inventory shortages strained by the Ukraine conflict, among a lot of other things. Also, restrictions on licensing, that's right, and drilling, and increased national, can't say national today, everyone, electric power needs. So that's right. It's not just a conflict in Ukraine. We're seeing huge restrictions, regulations put on these gas companies, licensing, like they said here, drilling. And what this is this a self-imposed crisis. This is the government's fault through their policies. Yes, obviously the conflict in Russia and Ukraine hasn't helped. It's made it worse. But this is a big, big problem we've been facing for years. And we're going to face it with power. And we're also going to face it with oil because the US, and it's not just US, in Australia here as well. When I was working in the energy industry about 6 years ago, I would see electricity prices go up about 15% every year. And they would come and would have meetings at the power company I used to work for and say, okay, they shut down another coal power plant. And I think they probably shut down about 5 plants while I was working there throughout 4 years. So this is definitely a problem that our government has made for us, and it's only going to get worse. So SoCal Gas files this rate increase during a time of transformative change, and his president said in a release May, events in California and around the world have shown us that maintaining the safety, reliability, and affordability of our local energy systems remain critical. Well, they're saying one thing, it doesn't look like they're doing that, everyone. So news of the possible rate increases has sparked some opposition from residents who commented on the state's utility commission website. He says he's definitely against this, the proposed increase, and feels that it borders on being criminal. This is what a Cathedral City man wrote. I would encourage the California Public Utilities Commission to look at other ways for managing expenses to prevent such an increase. Another person said a Riverside resident on fixed income told the commission her bill had already increased to $650. This is absolutely crazy. $650 for a monthly gas bill. I assume that's monthly, not quarterly. As she said, "You are killing us. We need heat in order to live," the woman wrote. "This is just price gouging your customers and forcing people to live miserable lives. Stop the insanity." So that's another big issue, everyone. When winter comes and people can't afford to pay the gas bill, we're going to see massive consequences of this. It's going to cause a lot of health issues. People are going to get a lot more sick. And, this is just an essential human need that these policies our government is doing is absolutely destroying people's lives. But it doesn't seem anyone's talking about it because, of course, we all want to go with the green energy transition to save the environment. Yes, I want to do that. I want to save the environment, but we can't just shut off gas, coal, and oil overnight. It needs to be, a sensible transition. So SoCal and the California Public Utilities Commission will host 2 online public forums March 6th and March 15th to hear public comments and concerns about the increases. And the public can also provide written comments. So if you're living in this area, to the State Utility Commission, and about 15 people commented by Feb 27th. So this is another absolute crazy thing what's going on right now. Everyone, with gas prices surging, with petrol prices rising, with food costs rising. And it's quite funny because, they exclude energy and food prices from inflation. They say, well, look, if you exclude that, and, if you exclude cars, if you exclude houses, if you exclude rent, look, there's no inflation, nothing to worry about. But literally all the things that are essential for humans to survive are going up absolutely crazy. And people just simply aren't going to be able to sustain this. And we're going to see a huge cost of living crisis and a huge homeless crisis, I think, over the next year, especially with interest rates going up. So this is absolutely crazy. I'm just having a look at the chat here, everyone, seeing how everyone's going. Okay, so heating oil cost is about the same as diesel. Good thing we had relatively winter here in Northeast. Okay, so let's now go on to our next story, the housing market. So it's going to be big things coming for the housing market. So look at this. Everyone thought that, mortgage rates were making their way down again. Well, we can see here, the US 30-year mortgage rate rises to its highest level since mid-November. And I think we're about to start to see those 7% mortgage rates again, everyone. So the contract rate on a 30-year fixed-rate mortgage rose 9 basis points to 6.7%, the highest since the week ended November 11th, according to Mortgage Bankers Association. The group index of mortgage applications to buy a home fell for a third week and still the weakest reading since 1995. Now, also here, the Federal Reserve has just put out some comments and some analysis and research, and they say U.S. home prices could plunge 20% as risk of a global housing slide looms, Dallas Fed says. So this is right, everyone. It's not just going to be a US housing market crash. Where I'm in Australia, house prices are crashing much faster than in the US. That's because most people have variable interest rates here, at least they did before the pandemic. Now, a lot of those people that did fix their rate below 2%, that's right, you could get mortgages below 2% here in Australia. They're going to be expiring, about 800,000 of those late this year. And again, in Europe, UK, etc., we're going to see a huge housing market crash. So let's see what they think could trigger this crash here. So US home prices could plunge nearly 20% as erratic market activity and rising interest rates drive a risk of a deep global housing slide, the Federal Reserve own researchers said in a report Tuesday. So that's right, everyone. Erratic market activity. So we saw absolute crazy house price rises during the pandemic. Some areas, doubled or went up 50%. This was just simply unsustainable. And this was driven by a lot of FOMO. A lot of people were buying holiday homes. A lot of people were moving. But we're now going back to more normality. So maybe a lot of people that thought they could afford that holiday home, they're going to be forced to sell that. Maybe people that moved interstate, maybe they don't like the move. Maybe they want to move back home. So we're going to see a huge correction in the housing market to get things back to more normal levels. And there's a lot more indicators here to prove that the math right now for the housing market just doesn't make sense. So Dallas Fed economists pointed to signs of trouble in the US and German housing market, and I guess you could pretty much say everywhere else in the world, that pose a vulnerability to the global outlook because of the size of those nations' economies and significant cross-border financial spillovers. So the researchers noted exceptional growth in key housing market indicators such as home price to rent ratio and real house prices show signs of affordability crisis. So that's another thing I don't hear many people talking about right now. The rent, the yield you can get on homes right now just don't make sense. They're building a new estate next to where I live, and a house is around $600,000, but they're only going to rent for about $420 a week. So if we go $420 a week, and if we times that by 52 weeks, so that's $20,000. So you're only getting about a 3% yield there on a $600,000 house. Maybe a bit more than a 3% yield, roughly. Just doing some quick math here. So simply, why would you invest in real estate? And that's gross yield before expenses. When I'll get into a moment, people are piling into bonds right now. You can actually get a 5% risk-free yield unless the US government defaults, or here in Australia, I'm sure a lot of other bank accounts, a lot of banks are offering 4.5% interest on deposits now. So why would you invest in real estate when it's a lot of work? You have to manage the property, manage the tenants, deal with maintenance, when you can just simply put your money in the bank, get 4% interest doing absolutely nothing, or just buy a short-term treasury bond. So also here, so price to rent ratio compares home prices to the cost of annualized rent. So Jake, thanks for that super chat here. The $2, thanks for that, mate. So US home prices would need a 19.5% correction to bring the US in line with its fundamentals, researchers Lauren Black said in a report. So we go down here. In a recent note to clients, Goldman Sachs projected that home prices will fall 6.1% this year on the national level. So with interest rates rising on the 30-year fixed rate mortgage to 7%, what I think we're going to need is we're going to need the unemployment rate to tick up to force people to sell. We're going to need inventory to start ticking up, and we'll have to see what happens. But like I said here, Fed says the prices could fall 20%. And I think that's definitely likely because, like I said, the rent ratio, investors aren't going to be buying all these hedge funds that were piling into real estate to buy their single family homes. Well, they're just going to go into bonds. And I'll get that into a moment. So just a quick sip of water. Good old H2O before we get into our next story. Thanks for that, Rodney from New Zealand. I assume that house prices aren't going too good in New Zealand as well. Thanks for the super chat there, Rodney. Thanks again, Jake, for that, for supporting the work here. And hope you're enjoying the content. Hope everyone's enjoying this live stream. But yeah, we got another report here. Like I was talking about, that investors are now going to start piling into the bond market, and this is going to put pressure on the stock market. So look at this. Cash-like ETF attracts $2.6 billion in biggest haul since 2020. So short duration bond funds see huge inflows as stocks whipsaw, and 6-month treasury bills now yield 5% as high since 2007. Because look at this. I'll move myself here. This is the list of the treasury yields. We can see here on the 3-month, it's now yielding 4.8%. But look at this, 6 months, you can get 5.1% on a 6-month bond right now, while you wait for the volatility in the stock market to fall. The 12 months, you can get a 5.02%. Now, again, you have to wait till duration, so then your money's locked up. That is a risk if you have to sell, and then all of a sudden the bond prices fall, which I think the bond prices will fall before duration, because we're going to get yields keep continuing to rise. That's a risk. But if you held it to duration, you'll get 5.12%. And again, with risk of stocks falling further, you're going to have a lot of hedge funds putting money into bonds, and a lot of these hedge funds that were buying homes. And we can see the 10-year, this is why we saw a lot of volatility in the markets today, and we saw specifically the NASDAQ, the high growth tech sector, they sold off more than the Dow, because as interest rates go up, that affects the growth stocks more. That hit 4% today. So let's continue into this report. So nearly 2.5 billion, like we said, flooded into the 23 billion iShares short treasury fund ETF, ticker SHV. I'm not telling you to invest in this at all. This is just covering the news here. So the haven appeal of cash-like positions climbed with reliable returns, mean investors have an attractive place to wait out volatility, according to Citi Growth Wealth Management, Christine Bitterly said. So thanks for that, Don Walker, for that super chat. So we can see this chart here. I'll go ahead and bring this up and again minimize myself here. I'll just remove myself here. So we can see this spike here at the end 2023. This is its highest since 2019. So we're going to have a lot of big money flood into bonds while they wait for more opportunities in the stock market. And hey, I may even start buying some bonds with these yields around 5% as well. I don't think, given the strength of growth data, that the inflation upside surprise will diminish soon, said Peter Chatwell, head of global macro strategist trading. The risk of further hawkish rates repricing will make the shorter end of the curve look even more attractive as income generating safe haven. And thanks for that, Sean. Thanks for that super chat. So this is what big money does. You know, they send their money, or the big hedge funds do. They change between asset classes. They're not married to one asset class. They'll put their money into stocks when they think stocks are at fair value. Then if stocks are overvalued, they'll put it into bonds. Then when they think, okay, we're not getting enough yield on bonds, we've seen stocks correct, and they go back into stocks. So I think we're going to see this happen more and more. And especially, I think key date is going to be the next Federal Reserve meeting when they give the dot plot, and also the next CPI report. If we get another hot inflation report, we're going to see yields spike yet again. So thanks, T8 Chatman. I'll try and get into the super chats at the end of it just so I can keep the show flowing. So that's what's happening with the bond market. Big money flowing into there. That's going to give competition to stocks. It's going to give competition to real estate. And that's why we're going to see, I think, some moderate returns, or I think we're going to see much weaker growth in stocks because now they're getting more competition compared to what's been with interest rates near zero for the past 10 years. But let's get into our next story, and this is more of the geopolitical side of things, but we as investors have to pay attention to geopolitics, because we saw what happened when Trump went into a trade war with China in 2018. That gave some negative headwinds for the stock market. But I think the trade war between the US and China is about to get even worse, and I hope it just stays a trade war, not gets into a Cold War or an all-out conflict. Let's go ahead and have a look here. So we can see here, China CCP warns Elon Musk sharing the Wuhan lab leak report. So we did just get a lot of the mainstream media is admitting this now, that it is likely that the origins of the cough, I'm coughing right now, came from Wuhan. Now, again, they didn't say 100% as guaranteed it did, but what's very convenient is the timing that they released it. Right as Xi's about to have a meeting this month with Putin, right after, the China spy balloon went over the US, now all of a sudden the mainstream media releases what most of us, spoiler alerts, or should I say conspiracy theorists, already knew. So it's very, very a big coincidence, I think, the timing they're releasing this now, when they probably had the information all along, and the big man, the orange man himself, also knew this all along as well. So let's get into this report here. I'll just move myself here. So a Chinese state-run newspaper issued a warning to Tesla CEO Elon Musk after he shared a report on the US Department of Energy's low confidence assessment that the global COVID pandemic originated in a Wuhan laboratory. Now, I'll get into a moment why this is so big, because China is the second biggest market for Tesla and also for a lot of other companies. So with a lot of these big US companies, like what we're seeing with Apple right now, they're having to diverse their manufacturing from China because of all the issues that happened with the factories there. We saw the working conditions for the people. It was very, very poor. So we continue to see the relationship between US companies and China deteriorate, like what Musk is doing now. Things are going to get very, very bad for these companies' earnings because they're going to lose a massive market, China. So CNBC reported Tuesday morning in a warning from social media pages of the Global Trade Times, the English language subsidiary of the government-controlled People's Daily. The Global Times warned Musk that he could be breaking the pot of China after Tesla and Twitter CEO responded to tweets that asserted that the COVID pandemic originated in a Wuhan research laboratory. So we can see here, she tweeted here, Miss Yoon, Communist Party paper warns Elon Musk against pushing the lab leak theory. Post on social media, Elon Musk, are you breaking the pot of China? So, they're kind of setting a warning here. We're a big money pot here. We're the one feeding you. We're the one that's, selling a lot of your electrical vehicles. If you continue to release the truth, which I think there's going to be big consequences. Well, I think, it's already late. The cat's out of the bag now, and it's just going to get worse. So the saying is akin to the idiom to bite the hand that feeds you, Yoon reported. Tesla has an expansive factory campus in Shanghai and China, and is the electrical vehicle manufacturer's second largest market. So need some more water here. So that's right, everyone. This is going to be huge, and it's going to be huge for a lot of other companies. So thanks for the super chat, Chill AZN. Thanks for that, Mike. Thanks. Yeah, that's right. I can't handle Jay Bravo's hair. That's too much for me. So the Department of Energy concluded with low confidence. This is quite funny. They say low confidence. I think very high confident that it did come from Wuhan. That the pandemic began in Wuhan laboratories. Sources familiar with the matter stressed to NBC News that the conclusion was not viewed as hugely significant. The FBI reached a similar conclusion at a moderate confidence level in 2021. Okay, and so the governing Chinese Communist Party has been highly sensitive to the matter, especially as its courts outside investment after months of zero COVID lockdowns prompted nationwide protests, Yoon reported. I'll get into the Australian market in a moment. Thanks for that super chat. So also, that's not all. China mocks TikTok ban on US government devices and asks why top superpower fears just a young, people's app, young innocent app. Nothing to worry about here at all. So we got issues with TikTok with the US right now. Tesla, Apple, I think we're going to see like Domino's, more and more companies start to restrict or maybe stop their progress in China. Now, again, this is going to make inflation worse because we've had globalization, which has kept costs low. But with the end of globalization and people diversifying their supply chains or bringing their manufacturing back on shore, which I think they should do, but that will make inflation worse. And this is the reason why I haven't signed up to TikTok. I've already got the CIA spying on us using American apps. I don't need the CCP spying on me as well. So let's continue reading here. So how unsure of itself can the world's top superpower be to fear young people's favorite app like this? So again, you're going to have a lot of these young kids protesting, no, I need my TikTok. I need my 15-second dopamine hits. The US has been overstretching the concept of national security and listen to this hypocrisy, abusing state power to suppress foreign companies. I'm sure China doesn't use its state power, doesn't abuse their state power at all, everyone. So the director instructed federal agencies on Monday to develop a plan to delete TikTok from all government devices and systems within 30 days, according to a memo obtained by Fox Business. Now, why they haven't already done this is beyond me. I thought they should have already done this a long time ago. And sorry, this video is about to play here in a minute for Fox. It always refreshes. I'm surprised the US government hasn't done this already. But again, this is just further escalations. The relationship between the US and China is getting worse. So the directive comes after Congress passed the No TikTok on Government Devices Act as part of its massive 4,115-page government funding bill in December, which instructed the Office of Management and Budget to ban the app. We firmly oppose those wrong actions, Mouse said of the act. The US government should respect the principles of market economy and fair competition and stop suppressing the companies provided an open, fair, and non-discriminatory environment for foreign companies in the US. Well, I'm sure, China doesn't do that as well, everyone. Lawmakers have increasingly sounded the alarm on TikTok and enormously popular short-form video app owned by the Chinese company ByteDance, and dozens of Republican and Democrat governors have banned the app on state-owned devices. Another sip of water here, everyone. Sorry. Not used for talking so long. used to just doing the 15-minute videos. So I'm losing my voice around. I'm going to have to wrap it up. But what this simply means is, in simple terms, like I always do, more inflation coming, more interest rate hikes coming. The housing market is in big trouble. People are going to be flooding into bonds, and the relationship between US and China is getting a lot worse. So we're going to see more geopolitical issues between the US and China, and that's something the market isn't prepared for. So everyone, thanks for watching. Thanks for all the super chats. I'll see you.